Head Harvester Bill Armin here from the West Coast.
And Head Harvester Ed LaFlamme from the East Coast.
And we want to talk today about basic financials and direct cost of goods, and overhead, above the line, below the line, all that stuff. So we just kind of get a basic understanding of how this whole thing works.
Right, yeah, because Lauren and Bobby, they've been you want to understand the concept, right? That's the key part of this, right? Mm-hmm. That's the whole thing.
Sure.
So let's review it, okay? Let's review the whole thing again. So Bill has adroitly put on the wall for us. You've got revenue, and you can take the revenue and you can lump it together, or better to separate it into cost centers or departments.
Yep, right.
Okay. So then you have your revenue. Then you have your direct cost. Remember what the direct cost was? What was the direct cost, guys?
Your labor and plus your burden,
Right.
workers' comp,
Yep.
and material.
Perfect. And then so that equals that. Then you're going to take that cost, subtract it from
Your
revenue, and you get.
your gross margin.
There you go. Excellent. Or your gross profit.
Right.
Yeah. QuickBooks, they like to call it a cost of goods sold, which is direct cost, and so they can call it a gross margin and gross profit. Then everybody says, well, what do you do? Where do you pay for the gasoline, the insurance, and all the other things? Well,
Hey, before we get there, Armstead, let's talk a little bit. The gross margin, we like to see that minimum 45%.
Good point.
Afterwards, after you subtract out, 45% minimum. And your goal is going to be in 3 years, 50%.
Yep.
Absolutely.
Okay, so now, wait a minute. There's more fun. There's more bills to pay. Not only up here the direct costs, you got to do the indirect or the overhead costs too.
Right.
So take it from there.
Yeah. So that's where all the money comes. So if you made $1 million with a 50% gross margin, you'd have $500,000 to cover the overhead.
Right.
Or as Harvester Bill always affectionately says, the knot. and so that covers your pay, the equipment, the insurance, the gas, the rent, all the overhead expenses.
Right.
Even paying for all your vehicles and equipment, all that.
Yep.
And then what's left, according to book, okay, we talked about before, book, is net profit. Of course, for a small company, generally what you do, the accountants have you take all that equipment in the form of depreciation and apply it towards that net, so you wipe out a lot of that net profit. Okay, but according to book, we know that's not the case. We know we're making a healthy net profit. That's the key.
So just to recap, so you got revenue, you got gross margin. If that equals 45%, and your overhead represents 35%, subtract 35 from 45, that leaves you a 10% net profit.
Okay. Yeah.
So that's about the rough average, 35 to 40% in overhead, 45 to 50% in gross margin. That'll net you. You got to make enough gross to cover the nut to make the net.
Got it.
So one more last point. So when you estimate the job, then you price the job, you're using this formula. Then when you do your job costing on that job, you're still using that same formula. Then when you're taking the information and transferring it to your profit loss statement, it's the same formula, you see?
Yep.
And then it's very clear because each phase of it is all the same. It's very easy to track, and you can benchmark not only among yourselves how you're doing, but against many companies all over the country, because many companies are doing it this way, including the largest company in the world.
That's right. So don't forget, revenue minus your direct cost equals your gross margin.
Simple as that.
Got
You
it.
got it, guys?
Yeah.
Awesome.
All right.
Awesome.
Head Harvester Bill Armin here from the West Coast.
Head Harvester Ed LaFlamme from the East Coast.
Now go out there and harvest your potential.